Hello and welcome to Currency Point, presented by me, Evan Lucas, for FP Markets. As always, have a very good read through of the disclaimer on screen. Everything in this video is general in nature, none of it should be relied upon as any form of advice. FP Markets does not know your personal scenario nor your personal financial goals, and therefore none of it should be relied upon as any form of advice at all. It's just general in nature only. I want to put my hand up very clearly, and I'll come back to this at the back of this video too, to talk about euro dollar. It has caught me off guard, and I'm fully aware that that's certainly where it's at and how fast the appreciation has got inside that pair particularly. We're staring at a 4-month high and it's not showing any signs to slow down. And I'll come back to that in a minute. It'd also be remiss of me not to start off with what happened last week in cryptocurrencies. I'm not a follower, I'm not a believer, and I'm not a nothing in anything with regards to crypto. I stay right away from it. But what it does show is that volatility is always in the background of what we do. And it also shows very clearly that you need to be aware and very ready for when it does eventuate, like it did happen last week in cryptos and probably will for a little bit time to come, that you need to be vigilant. And I think that's the way to look at the crypto story at the moment, is that if you are in it and you are doing what you do with it, then that's great, as long as you're fully aware of the risk that comes with what we do, which is trading, and trading always has an inherent risk that comes with it. And that's what cryptos certainly showed us last week and have been for probably many, many years. Getting back to FX then, the volatility is also starting to slip into that as well. And I'm going to come to the US dollar because at the moment, it's my base for everything. I am actually using pairs rather than using crosses. I think there's enough information coming out of the States to really give you a chance to choose a pair or multiple pairs to really play that US dollar story. And the interesting thing that's come out of this, we've been talking about it for a couple of weeks, is that Fed speak is starting to really win, inverted commas. What I mean by that is that the Fed, even with CPI 2 weeks ago, even what we're seeing with regards to most of the data that's coming out of the US is very dovish. I'll come back to Robert Kaplan in a minute, but let's have a look at the data. If you have it, jobless claims last week, they were better than expected, although overall claims are slightly higher. If you look at the FDI Fund PMI numbers, they were better than expected and still remain above COVID levels, even with a slight slowdown. The only caveat was the April housing data, and there's a big, huge caveat to that anyway. It was negative, there's no doubt about it. There was a really big fall in what was happening on there, particularly in first homeowner numbers. But that was because, don't forget, back in February we had the polar freeze, and that polar vortex created an absolute surge in March. So to have a month-on-month decline is probably not unsurprising, and to see that slowdown that we saw year on year is also explainable. The caveat on top of all of that, though, is that what we are starting to hear, and this is the risk that we've been talking about, is that supply chain disruptions from COVID are still very much a real issue. And it's not just with housing, it's across particularly discretionary spending as well, that getting product is getting hard. So just remember that. And therefore it does add a little bit of volatility. But overall, the data was positive, and it would have been expected to see a bit of a dollar positive movement. Then you had Fed speak, and Fed speak has been pretty strong in terms of what we see, even with the minutes, which initially showed a slight uptick in USD. As the more and more you delved into it, it just shows how strong overall, particularly the voting members of the Fed are with holding the current policy. And that's in the list that I've put out in my note today. Have a look at what they really highlighted, which is that they are still very much on the belief that policy and policy guidance is correct and shouldn't change. They don't believe you should be even considering or even talking about the idea of tapering. Not all of them. And that was one of the big caveats, is that participants did note that there are some that if they continue to see growth on current path and inflation on current paths, then we should discuss it, but it's a small number. And the majority, as I said, are all saying the same thing, that they believe that inflation is transitory, which is pretty easy to argue, particularly with what's going on right now. This time last year was the peak of the pandemic over in the States. And if you look at it year on year with that kink in it and the basically trend in inflation from around about 2010 to where we are now, it looks like this. Once you get to May, once you get to June, that kink will filter out and you'll probably see inflation going from being that really strong 4.2% on the headline, that 3% on core, to dropping back towards that 2% that they believe it will be. So that means a negative US dollar outlook, because it means tapering isn't coming. It means the 120 billion US dollars per month is going to continue to be pumped into the market. It's a lot of flow, and that's why at the moment, getting back to my euro point, I've been caught out, and I'm open to that, and I'm fully aware that it's gone above what I thought would be the range for the second quarter, which was 121.5. We're now at 122 and a bit, and it looks like testing the real support, the resistance level back in the day of 122.75. If it breaks that resistance, that's a new support level, and it should actually start to take off even more. And that would be quite an interesting thing because it brings the EU into play. They have got no firepower, or at least suggest they don't, in where they sit. Their recovery is still quite stuttered. You are starting to finally see some reopenings in the European Union, which is great to see, but they're so far behind what's been going on the other side of the Atlantic. And that in itself was interesting when you have a high euro. It's certainly not to their advantage. And it is therefore something to watch towards the back end half of the year as you start to see politicians start to feel that pressure and talk about it. Also can't not go past what happened in dollar yen. It's been a big favorite of mine for the most part of this year, but I have gone away from it. It's now starting to show very strong levels of volatility into movement between 108.5 and 109.75. Although it's not moving outside of that range, which is not bad, it's the pip movement. You're seeing 30 pip movements in seconds, and that makes and suggests to me that it's probably lost its direction. That link that it had to the bond market has stopped, which is not surprising considering the calmness that we've now seen come back into that market, but also it doesn't give me any direction. So I've actually finally said, and I'm out of what has been a great trade, the dollar yen, to actually start looking elsewhere in those pairs.